Welcome to the Make It Personal podcast presented by Mutual of Omaha Advisors. Make it personal. It's your money. It's your plan. It's your future.
So how much of your retirement assets should be invested in the stock market? That's a question that's probably been asked and answered for decades. Though admittedly, it's likely become more popular as employers have shifted more and more away from traditional pension plans and put more of the burden for retirement savings on the employee. The dirty little secret is that you may likely need to have a good majority of your assets invested in the stock market during retirement, especially as many of us may live 30 or more years in that phase of life. For some, that may be more years in retirement than they spent working towards and saving for retirement. Unless you've amassed significant assets where you can simply live in retirement off interest payments, you'll likely need to be exposed to stocks or equities in some way. Inevitably, the stock market will have down years. What goes up must come down. And we know that survey after survey show us that Americans generally feel poorly prepared for retirement. A study by LIMRA tells us that only 3 in 10 US consumers think that they are well prepared for retirement. Yikes, that's a bit sobering. Before I go much further, please allow me to introduce myself. My name is Mark Zagurski, and I'm the Director of Strategy and Communications for Mutual of Omaha Advisors. Yes, Omaha, somewhere in Middle America, and also somewhere much closer to Main Street than we are Wall Street. I've been in the insurance and investment business in some form or fashion for over 30 years. Yes, I know, it's hard for you to believe while you're looking at me. I could go deeper into my credentials and even flash them on the screen, but then I'd have to get even more of our corporate censors involved. More important than any credentials that I have is who I represent. I represent the voice of a network of Mutual of Omaha advisors nationwide. I've been blessed to be involved in the development and coaching of hundreds, if not thousands, of advisors who spend their days trying to help as many people as they can in imagining, planning, and securing their futures. It's likely that it may be one of our current advisors who introduced you to this video and why you might be listening right now. It's through those interactions with our advisors over the years where I've been able to gain incredible insights as to what is most important to you when it comes to retirement planning. Okay, back to the LIMRA study. Whether you're part of the 3 of 10 that feel they're well prepared or the 7 of 10 that feel they are not, we know that pre-retirees want help with 3 distinct planning activities. First is estimating how many years their assets may last in retirement. Second is developing a plan for withdrawals or spending down those assets. And third is creating a comprehensive plan to generate income. I can simplify it even further based on working with our advisors. Most people generally want to know, A, how much they'll need to retire, and B, when they'll be able to retire. While on the surface these appear to be 2 different things, they're really one and the same. At the end of the day, what's it going to take for you to be able to retire? That is the question. As you plan for retirement, there are a number of risks that you need to take into account. Spending too much, investing too conservatively, and not sticking to your plan are some of the most common traps that you can fall into on your way to retirement. A little discipline and the help of an advisor can go a long way to help you avoid these. There are other risks, like having a healthcare crisis, which can't be avoided, though you can definitely have a plan in place to help manage them. There are certainly other risks that retirees will face, including one in particular hidden in plain sight. The market goes up, the market goes down. While this can be a little disheartening during the time where you're accumulating money for retirement, though it certainly can afford you with opportunities to purchase more shares when prices are lower. I've heard it said before that once you retire, every day is Saturday. When you are retired, you don't want to wake up each morning worried about the stock market. Experience a market drop in the early years of retirement can create problems that go beyond the immediate hit to your portfolio, potentially to the point where your money may not last as long as you do. The phenomenon here is commonly known as sequence of returns risk. Sequence refers to the fact that the order and timing of poor investment returns can have a significant impact on how long your retirement savings last. In simplest terms, then one of the most basic financial issues in retirement is, will our money outlive us, or will we outlive our money? A long and healthy life is a blessing, but it's natural to worry that you'll run out of funds at some point, which could create a financial burden for your loved ones. Many people underestimate the money they'll need to enjoy a comfortable retirement, often overlooking that today's retirement can last 30 years or more. As reported by the Society of Actuaries, the average life expectancy for a man reaching 65 today is 87 years, while for a woman, it's 89 years. For a couple age 65, there's a strong likelihood that at least one partner will live until age 93. So is there anything you can do to prepare for sequence of returns risk? The good news is, while sequence of returns risk cannot be avoided, you can certainly have a plan to minimize the impact. Let's take a look at 3 things you can do to help minimize the impact of sequence of return risk in order to try to protect against outliving your money. First, we have to plan for market downturns. Not we have to have a plan for market downturns, which will come later. Instead, we have to expect that market downturns will happen. According to HartfordFunds.com, the long-term average frequency between bear markets is 3.5 years. What's a bear market? Generally speaking, a bear market is a time when stock prices are declining and the market outlook is pessimistic. Again, according to HartfordFunds.com, bear markets have been less frequent since World War II. Between 1928 and 1945, there were 12 bear markets, or one about every 1.5 years. Since 1945, there have been 15, or one about every 5.1 years. Again, the market goes up, the market goes down, and without such volatility, there would be no opportunity for growth. Bear markets are very normal. There have been 27 bear markets in the S&P 500 index since 1928. On the other hand, there have also been 28 bull markets in the S&P 500 index since 1928. Stocks have gone down 35% on average in a bear market. By contrast, stocks have gained 111% on average during a bull market. We have no control over when a bear market may occur any more than where a bull market may occur. Our assumption is that the stock market will continue to do essentially what it's been doing over time. And when the market declines meaningfully, we can say, we plan for this. Second, we need to diversify our assets. Part of planning for market downturns comes in making sure that our portfolio or retirement assets are diversified. Diversification is the spreading of your investments both among and within different asset classes. Diversification can help reduce the risk of losses that can result from overemphasizing a single security or single asset class, as well as to lessen the impact of market downturns. Asset allocation for any individual will depend on a number of factors, including your tolerance for risk and your investment time horizon. Asset allocation alone is not enough to effectively manage risk, and sticking to your plan during a market downturn can be tough. This can be especially true if you're not working with a financial advisor that can coach you through the downturns and remind you of the plans that you put in place. Okay, on to number 3. It's to create a volatility buffer. All right, let's accept that the first 2 I shared with you are fairly basic. Anticipate drops in the market and make sure that your assets are diversified. We're not splitting the atom with these first 2. Yes, we need to anticipate and expect down markets. We also need to ensure that our money is allocated in a diversified way that aligns with the level of risk we can tolerate. But where the first 2 can quickly fall apart is when we experience that first market downturn and we do not have a plan in place for it. For our purposes, we're going to call that plan a volatility buffer. A volatility buffer, in the context we're discussing, is a strategy or a plan that we can use that helps protect against significant drops in market value. The financial products we may use to create a volatility buffer can differ from situation to situation. Though having an emergency fund and considering non-traditional assets or income sources such as annuities, life insurance, or even reverse mortgages may come into play. Here's a relatively simple example when it comes to sequence of returns and creating a volatility buffer. Let's say you're turning age 65 and you have $1 million saved for your retirement in your 401k plan through your employer. It's invested or allocated primarily in stocks or equity securities, for which you will use the S&P 500 index as a proxy. You're ready to retire, and you determine that based on your needs, that $80,000 per year of income is what you need to live comfortably in retirement. Of quick note, that $80,000 represents 8% of your initial $1 million. If we take a look at the S&P 500 index returns from 1997 to 2022, a 26-year period, we find that the average rate of return is 8.3%. So you may go in thinking that your 8% withdrawal rate is okay because you're just taking the earnings off the top and it'll help you keep your $1 million largely intact. Well, as you'll see in our scenario, that assumption can quickly lead you astray due to the impact of sequence of returns. If you look at the actual returns from the S&P 500, you'll quickly notice that during the years 2000, 2001, and 2002, that the index produced a negative return. As we previously discussed, negative returns are not unusual, and we need to expect them. While having 3 years of negative returns in a row may be unusual, it happens. In this scenario, these 3 years happen to be 3 of your first 6 years of retirement. We continue to withdraw our $80,000 or 8% each year, despite the fact of what the market's doing, as we have a need for income and do not have a plan in place to do anything otherwise. The impact that this has on our assets that we're using to generate an income is irreparable in this scenario, causing us to exhaust our assets or run out of money by 2022 or our 26th year of retirement. We retired at age 65, and 26 years later, we'd be 91 years old. The average life expectancy for a man reaching 65 today is 87 years, while for a woman, it's 89 years. These numbers represent the average person turning 65 today, which means half will live a shorter time frame and the other half will live longer. If you recall, for a couple turning age 65, there's a strong likelihood that at least one partner will live until age 93, thus facing the real prospect of being in their early 90s and having fully exhausted their assets. Now let's take a look at the same scenario, but this time we'll put a very basic volatility buffer plan in place as we anticipate downturns in the market. In the second scenario, we start with the same $1 million in our 401k plan and the same need for $80,000 of income annually, or 8% of our portfolio. This scenario is subject to the same historical returns of the S&P 500. The difference in scenario 2 is that we put a volatility buffer strategy in place, where we agree that we will not withdraw money from our portfolio after a year where we have a negative return. During this 26 years, there are 7 down years or years of negative returns. So a little more than 1 out of every 4, or not too far off those historical averages of once every 3.5 years that we talked about earlier. In our example, we employ a volatility buffer strategy where again, we do not make any withdrawals following a down year. In this practice, there are 5 years where we would not withdraw the $80,000 from our account. I'm including 5 instead of 7, as there are 2 years in which we do not withdraw since the S&P 500 was essentially a push or was down less than 1%, and the other negative year came at the end of our example, which was the last year, 2022. Now let's compare the results of scenario 1 versus scenario 2. In the first scenario, we take out a little over $2 million during the time frame, and we're left with nothing in the final year as we withdraw the remaining balance. Compare this to scenario 2, where we take out $1.68 million, and we still have over $1.2 million remaining at age 91. Not only do we still have money remaining to generate income going forward, but we've also got the opportunity to leverage some of these assets to create a legacy and pass money down to other generations in our family if we desire. All right, where are the pundits at? I know what you're thinking. Okay, we didn't take out $80,000 during those 5 years following market downturns. That doesn't mean that our expenses or a need for income went away. How did we generate income in those years? I'll share a few ideas, but I want to stress this is where sitting down with an advisor and crafting a plan specific to your situation comes in. At a high level, the first thing we would have needed to put in place for this volatility buffer strategy to work is having at least 2 years of income in an emergency fund or cash. Yes, at least 2 years worth of income, as you'll have the need to spend some of that down during negative years, and you'll need to replenish that fund from time to time. Next, you could consider working during retirement. A part-time job or side hustle may be a choice, especially in the early years right after retirement, when you're most likely still able to work physically. I realize that being a greeter at Walmart doesn't pay $80,000 a year, but what if you could find meaningful work, full or part-time, to offset some of that income need? This may be part of your strategy whether or not you encounter any down years. While you're able, even getting a job that pays $30,000 per year would make a big difference on how long that 2 years worth of income that you have in cash would last. Next, we could diversify our income sources, including the possibility of a reverse mortgage. Outside of retirement assets such as 401ks, home equity tends to be one of the largest existing retirement assets. According to U.S. Census data from 2022, home equity comprised 62% of the net worths of people between ages 65 and 69. That percentage trended even higher for older age bands, as home equity accounted for 63% of the net worth for people between 70 and 74, and 69% of net worth for people over age 75. The home is a large asset and needs to be considered as part of the total wealth and as a possible asset to generate retirement income. Some people can use it to downsize and reduce costs or free up equity. Others can borrow against it and use those funds to support those spending needs. Tapping into home equity through a line of credit or reverse mortgage during a market downturn can help provide needed cash flow to meet spending needs in retirement in lieu of selling investments during a down year. You can also consider other non-traditional asset classes such as cash value life insurance and annuities. While these do not prevent you from experiencing down years in the stock market, they can be used to provide income that is either guaranteed or insulated from the stock market. We're not suggesting that you put all your assets here. Instead, consider working with an advisor to see if you can develop a plan to cover your essential retirement expenses with guaranteed income from tools like annuities, and then leverage your assets that are invested in the stock market to cover any discretionary expenses. Wow, that's probably enough for today. Bottom line, retirement planning is complicated. It may be worth your while to consult a competent financial advisor rather than vloggers and financial celebrities online. It's certainly possible to go the DIY route, but you'll likely spend a significant amount of time and possibly money to learn everything you need to know, and even then, you still won't know what you won't know that creates risk. According to LIMRA, 3/4 of pre-retirees say creating a comprehensive plan to generate income in retirement is complex. Furthermore, only 11% have completed a formal retirement income plan. Around 40% of pre-retiree households working with an advisor have completed a formal written plan, and 2/3 of those with a formal plan feel well prepared. Remember, losses are linear, but required gains to offset those losses can be exponential. Frankly, there are some losses that could occur early in retirement that without the risk of having the right plan in place, you may not be able to overcome. At Mutual of Omaha Advisors, we understand personal finance is personal, and financial well-being is essential to achieving your life's goals. Our vision is for every customer to be able to imagine, plan, and secure their financial future. A Mutual of Omaha advisor can help you with your retirement planning and determining what role a volatility buffer may play for you. Make it personal. It's your money, it's your plan, it's your future.
This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. Mutual of Omaha Investor Services, Inc. does not provide tax or legal advice. Please consult with the appropriate professional regarding your personal situation prior to making any financial decisions. Strategies discussed may not be suitable for everyone. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Mutual of Omaha Advisors is a division of Mutual of Omaha Insurance Company.